In February, Ray Dalio posted something that sent shockwaves through every financial and geopolitical circle on Earth. A simple statement: it's official. The world order has broken down, not breaking down, not at risk of breaking down, broken, past tense, already done. And the man who has studied 500 years of empire cycles, who predicted the 2008 crisis, and who built the world's largest hedge fund by reading history better than anyone alive, says we have entered stage 6 of the big cycle, the stage that historically brings the greatest financial disruption, the greatest transfer of wealth, and the greatest danger to people who do not understand what is happening or what to do about it. Today, Ray Dalio explains exactly what stage 6 means, what it has looked like every time it has happened before, and the specific things you need to do right now to protect everything you have built. This is the most important video we have made. Pay attention. Let's get into it.
I want to take you back to the year 1933. Picture the scene. The League of Nations is struggling for legitimacy. Germany and Japan are withdrawing, driven by swelling imperial ambitions that the existing international institutions are completely powerless to contain. The rules that had governed international relations since the end of the First World War are fracturing in real time. The great powers that created those rules are discovering that the rules only work when everyone chooses to follow them. And when the most powerful players stop choosing to follow them, the rules simply stop existing. International trade is collapsing under the weight of tariff wars. Democracies are turning inward. The wealth gap inside nations has become so extreme that it is fueling internal political conflict that is tearing societies apart from the inside. And in boardrooms and governments around the world, serious people are quietly making decisions based on the assumption that the old order is gone and the new one has not yet arrived. That was 1933. Now I want to tell you what I posted on February 14th of this year, because I believe it is the most important thing I have said publicly in decades. And I believe it directly and immediately affects every financial decision you are making right now, whether you realize it or not. I wrote 3 words. It's official. The world order has broken down, not collapsing, not at risk, not under pressure. Broken. Already. Done. I have spent my entire adult life studying economic and geopolitical history across 500 years. I have built a framework I call the Big Cycle that maps how empires and world orders rise, reach dominance, decline, and eventually collapse into periods of great disorder before a new order emerges. And you have studied the Dutch Empire and the British Empire and the American Empire. I have studied the rise of China and the decline of Rome and everything in between. And in all of that study, in all of those cycles, one thing has been consistent. The people who understood where they were in the cycle, who read the signs that the old order was ending and positioned themselves accordingly before the transition was complete, preserved and grew their wealth through the disruption. The people who did not understand, who assumed that what had always worked would keep working, who trusted the stability of a system that was no longer stable, did not. I am not telling you this to frighten you. I am telling you this because the cycle I have spent my career studying has now reached a stage where understanding it is not an intellectual exercise. It is a financial survival skill. The 6 stages of the big cycle and what stage 6 actually means. Let me walk you through the framework that I believe is the most important lens for understanding everything that is happening in markets and geopolitics and economics right now. The big cycle describes how great powers rise and fall over periods of approximately 80 to 100 years, long enough that most people alive during any given stage have no personal memory of the previous time the world went through it, long enough to create what I call generational blind spots, the tendency of each generation to assume that the conditions they were born into are normal and permanent rather than temporary and cyclical. Stage one is the beginning of a new order. A new dominant power emerges from the chaos of the previous period. New institutions are built. New rules are established. Trust in the system is high because the people who built it remember the chaos that preceded it and are motivated to maintain the stability that replaced it. Stage two is the peace and prosperity stage. The rules work, trade expands, living standards rise. The dominant power benefits most, but the rising tide lifts enough boats that most participants in the system have a stake in maintaining it. This is the golden age. Stage three is the peak. The dominant power reaches the height of its influence, its military strength, its economic output, its cultural reach. But the seeds of decline are already present, usually hidden inside the very success that defines the peak. Debt accumulates. Overconfidence grows. The institutions that were built with humility start to be maintained with arrogance. Stage four is the overextension and decline phase. The debt burden grows faster than the economy. The cost of maintaining dominance exceeds the returns from it. Internal wealth inequality widens, creating political conflict that diverts energy and resources from productive investment toward managing domestic friction. External challengers grow stronger, while the dominant power grows weaker relative to them. Stage five is the crisis stage. The debt and political tensions reach levels that cannot be managed within the existing system. Financial crises, political upheaval, social unrest. The institutions that held the system together start to lose their legitimacy. The rules that everyone agreed to follow start to be ignored by the most powerful players because following them has become incompatible with their interests. And stage six is what I declared we have entered. Stage six is the period of great disorder. It is the stage where the old rules are gone and the new rules have not yet been established, where power determines outcomes more than law, where the assumption of win-win international cooperation gives way to zero-sum competition, in which every major player is trying to accumulate relative advantage at every other player's expense, where the financial system, the monetary system, the trade system, and the security system are all being restructured simultaneously in ways that create enormous uncertainty and enormous volatility. I posted that we have entered stage six, and I cited the evidence that convinced me we are truly there rather than simply approaching it. The German chancellor saying, the world order as it has stood for decades no longer exists. The US Secretary of State describing a new geopolitics era and warning against managed decline. The Munich Security Conference, the annual gathering of the world's most senior defense and foreign policy leaders, releasing a report titled Under Destruction, describing an era of wrecking ball politics where sweeping destruction rather than careful reform is the order of the day. When the people who are responsible for maintaining the old order are publicly declaring that it is gone, it is gone. What every previous stage six looked like and what it did to people's money. Let me show you what stage six looks like on the ground. Not in abstract geopolitical terms, in the specific financial terms that determined whether ordinary people preserved their wealth or lost it. The transition from the Dutch Empire to the British Empire in the late 1700s was a stage six period. The Dutch guilder, which had been the world's dominant reserve currency for over a century, lost its status as the British pound took over. People who held Dutch guilder-denominated assets saw the real value of those assets decline dramatically as the monetary system restructured around the new dominant currency. The transition from British dominance to American dominance that happened through and after the Second World War was the last Stage 6 transition. The British pound lost its reserve currency status. The gold standard that had underpinned the international monetary system for decades was dismantled. People who held assets denominated in the old dominant currency, who trusted the old system, experienced enormous real wealth destruction, even as the nominal numbers sometimes suggested stability. Every stage 6 in history has had the same financial fingerprints: currency debasement, the dominant power facing the costs of maintaining its position and the pressure of its debt burden inflates its currency. The real value of savings denominated in that currency declines. Prices rise. The people who thought they were wealthy discover that the number in their account does not buy what they expected it to buy. Taubio controls and financial fragmentation. As the international system fractures, as countries begin to compete rather than cooperate on financial terms, the free flow of capital that characterized the previous stable period becomes restricted. Assets in certain jurisdictions become harder to access. The assumption that you can move your money anywhere at any time starts to prove wrong. Asset price volatility of a magnitude that most people have never experienced. The repricing that happens when the framework that determined asset values is itself being replaced is not a normal market correction. It is a structural repricing. It can be severe, rapid, and disconnected from the fundamental quality of the underlying assets in ways that destroy wealth, regardless of how careful the investor was in their individual selection. And flight to real assets: gold, hard assets that produce real income, things whose value is intrinsic rather than assigned by the confidence of the system that is breaking down. In every stage 6 transition in the 500 years of history I have studied, the people who held real assets, who owned things whose value did not depend on any specific government keeping its promises or any specific monetary system remaining intact. Those are the people who came out the other side with their wealth preserved. The 1930s comparison and why it should alarm every investor alive today. I reference the 1930s deliberately because I believe the parallels to our current situation are close enough to be instructive and close enough to be alarming. In the 1930s, the world was experiencing a late-stage breakdown of the post-World War I order. Massive debt burdens accumulated during and after the war. Internal wealth inequality at extreme levels, rising nationalist movements that were gaining power precisely because the existing institutions were failing to address the economic suffering of ordinary people, and an international order that was fracturing under the weight of great power competition that the existing rules were insufficient to contain. The Smoot-Hawley Tariff Act of 1930, which dramatically raised American import duties in an attempt to protect domestic industries, triggered retaliatory tariffs from trading partners around the world. What began as domestic economic policy became an international trade war that collapsed global commerce and deepened the depression it was supposed to address. Does any of that sound familiar? The tariff dynamics I am watching today, the retaliatory cycles, the weaponization of trade policy in service of geopolitical competition, these are not new phenomena. They are the classic signature of a stage 6 transition, and the historical lesson of the 1930s tariff wars is unambiguous. When major powers engage in economic conflict of this kind, the people who pay the highest price are not the governments. They are ordinary citizens whose cost of living rises, whose job security weakens, and whose savings are eroded by the inflation that accompanies the monetary disruption. But here is the part of the 1930s comparison that I want to make sure lands with full weight. The 1930s did not end cleanly or quickly. The Great Depression lasted a decade. The political instability it produced, the rise of authoritarian movements that fed on economic desperation, the eventual military conflict that the great power competition escalated into. These were not separate events from the financial story. They were the same story playing out across different domains simultaneously. And the investors who navigated the 1930s successfully were the ones who understood that they were not living through a temporary disruption that the existing system would correct. They were living through a system change, a fundamental restructuring of the rules that governed everything, and they positioned themselves accordingly. What this means for your money right now, specifically and practically. Let me bring this from the level of history and grand cycles down to the level of your actual financial life, because that is ultimately what this is about. Not the intellectual satisfaction of understanding the big cycle, the practical question of what to do with the money you have worked your entire life to build. The first implication is the dollar. The US dollar has been the world's dominant reserve currency since the Bretton Woods Agreement of 1944. Every stage six transition in history has involved a restructuring of the monetary system around a new or revised monetary anchor. The dollar's dominance, which has allowed the United States to run deficits that would have been catastrophic for any other country, is part of what is being renegotiated in the stage six transition we have entered. I am not predicting the dollar collapses tomorrow. I am saying the trajectory is one of gradual, then potentially rapid erosion of the dollar's unique privilege. And every dollar of savings denominated in a currency that is losing its reserve currency status is savings that is exposed to a risk that most financial advisors are not accounting for in their models. The second implication is the bond market. In a stage six environment, in an environment where the fiscal dominance of the existing order is giving way to something new, the credibility of government debt is not the given that it has been for most of the post-war period. I do not like the prospects for U.S. stocks or bonds right now. Valuations for shares are stretched with high price to earnings multiples, and bonds face the structural headwind of a government whose debt dynamics do not support the confidence that bond pricing has historically assumed. When I look at a 30-year Treasury bond right now, I am looking at a promise from a government that is currently spending $2 trillion more per year than it collects in revenue, that is paying over $1 trillion annually just in interest on its existing debt. And that has no credible plan to close that gap without either dramatically higher inflation or dramatically higher taxes. That is not the profile of a borrower I want to lock my money into for 30 years. The third implication is geopolitical diversification. In a stage six period, in a period where the assumption of stable international rules and open capital flows no longer holds, concentration of all your assets in a single country's financial system is a concentration risk that most investors have never had to think about seriously before. I am not suggesting you move everything offshore. I am suggesting that the degree of geographic diversification that was adequate for a stable stage 2 or stage 3 world is not adequate for a stage 6 world. International equities, hard assets in multiple jurisdictions, exposure to markets that are not entirely dependent on the health of the U.S. dollar and the stability of the U.S. financial system. And the fourth implication, the one I keep coming back to because history is so unambiguous about it, gold. Every stage 6 transition I have studied has seen gold outperform, not because gold does anything exciting, because gold is the one monetary asset that survives system transitions intact. It survived the collapse of the Dutch monetary system. It survived the collapse of the British monetary system. It has survived every currency crisis, every empire transition, every period of great disorder in the 5,000 years that human beings have used it as a store of value. Gold is not denominated in any currency that can be debased. It is not a promise from any government that can be broken. It does not require any institution to remain functional or any system to remain stable. It is just real. In a world where the systems that assign value to paper promises are being restructured, real is the most important thing an asset can be. I want to end with something that I think most people miss when they engage with the big cycle framework, because the framework is not fatalistic. Empires in stage 5 and stage 6 do not have to follow the worst possible path. There are what I call life extending measures, specific actions that individuals and institutions can take to navigate the transition with their wealth and their well-being intact. The first life extending measure is radical honesty about where we are. Most people find it psychologically difficult to accept that the system they grew up in and built their lives around is genuinely changing. The familiar feels safe. The status quo has worked. Surely it will correct and stabilize. This psychological resistance to accepting change is the single most expensive mistake I see investors make in a stage 6 environment. The first and most important thing you can do is look clearly at the evidence I have just laid out, and accept what it is saying. The second life extending measure is building resilience rather than optimizing for the scenario you prefer. Most portfolios are built to do well if things go roughly the way the investor hopes they will go. A genuinely resilient portfolio is built to survive the scenarios the investor hopes will not happen. The difference is not about pessimism, it is about honesty. And in a stage 6 environment, where the range of possible outcomes is dramatically wider than in a stable period, the cost of not being resilient is dramatically higher. The third life-extending measure is what I call adaptive thinking. The rules that governed the previous stage of the cycle do not govern the current one. The investment strategies that work brilliantly in stage 3 and stage 4 are not guaranteed to work in stage 6. The assumption that American stocks will always outperform over long periods, that bonds will always stabilize a portfolio in a crisis, that the dollar will always be the safe haven in times of global stress. These assumptions were reasonable for the stage we were in. They are not necessarily reasonable for the stage we have entered. Adaptive thinking means being willing to update your framework when the evidence demands it. It means being open to the possibility that the map you are using was drawn for a different territory. There is great disorder arising from being in a period in which there are no rules, might is right, and there is a clash of great powers. I wrote that earlier this year, and every week since I wrote it, the evidence has continued to accumulate that it is true. The world your parents built their financial security in, the world the standard financial advice was calibrated for, the world where diversifying across U.S. stocks and U.S. bonds was sufficient protection against most risks, that world is gone. The new world has not yet fully taken shape. That is what a stage 6 transition feels like from the inside. Messy, uncertain, frightening in ways that are hard to articulate because the things that used to provide comfort, the familiar institutions, the trusted rules, the predictable patterns, are no longer reliable guides. But here is what I have learned from studying 500 years of these transitions. The people who come out of stage 6 in the best financial position are not the ones who were the smartest or the luckiest or the best connected. They are the ones who understood the cycle early enough to act, who built genuine resilience into their portfolios while the window was still open, who held the assets that survived system transitions, regardless of which direction the new system develops, and who did not wait for certainty before moving. Because in a stage 6 transition, by the time certainty arrives, the opportunity to prepare has already passed. The stage has been declared. The world order has broken down. What you do with that information in the next 6 months will matter more to your financial future than almost any other decision you make in this decade. Do not waste this window.
Stage 6 of the big cycle, the period that historically brings the greatest financial disruption, the greatest transfer of wealth, and the greatest danger to people who do not understand what is happening. Ray Dalio declared it official in February 2026, not a warning about the future, a declaration about the present. Your action this week: go back through your portfolio and ask one honest question about every single position you hold. Does this asset require the current system to remain stable in order to hold its value? Because in a stage 6 world, that question has a very different answer than it did 5 years ago. What do you think? Are we in stage 6 of the big cycle? Leave your thoughts in the comments below. And as always, I will see you in the next video.